Hello, welcome to another FinApp tutorial. Today we are going to be covering probably the most important module that we've ever built and the most sought out module that MFDs and REAs are actually using us for. This is the portfolio optimization module. I'm sure you would have heard about Deserve, Novelty Well, Power Up Money, etc. etc. These are D2C fintechs which has actually taken the market by storm by offering this quick portfolio review directly to the clients, which is the D2C fintechs, so to say. So this has actually affected the IFA market, the distribution market quite a lot because your clients would actually be signing up with Deserve. They upload their MF Central CAS or PDF CAS, and in a jiffy they will actually be able to be extracting all the recommendations, especially the buy, hold, exit recommendations, and they come back to you in terms of what they have actually analyzed. And typically the MFDs and the REAs wouldn't have an answer because you would have constructed a portfolio with a context. Deserve doesn't have that context, but they simply give the exit recommendation for a lot of funds that you've actually provided, and therefore putting you into a spot. And portfolio optimization is a tremendous feature that you can actually make use of in both the cases in terms of defending why have you recommended a particular fund with a particular context to your existing clients, and also for acquiring new clients. And that is where FinApp is mostly used for by the MFDs and REAs. Assuming that you sort of approach a prospect who's got existing mutual fund investments, you can just create them as a prospect in FinApp, upload their PDF CAS, and we're also coming out with the MF Central option very soon. We had it before, but we're sort of migrating to version 2 now. Okay, upload the CAS for now, and in a matter of about 5 to 7 minutes, you will actually be able to give a fantastic report, much better than what these D2C fintechs are offering to their clients in a span of about 5 to 7 minutes. So I'm going to be showing you how does the portfolio review happen, what are the next steps after the portfolio review. Okay, so let me first just show you that how do you sort of create a client or create a prospect, so to say, before you upload the CAS. So I'm just naming it as, let's say, portfolio review, and I am putting a dummy. I click on create clients and I go to my clients here, and I'll say portfolio review. So you can see that the client AUM is 0. I click on access, and here I go. There is this CAS upload. So sorry, I forgot to mention that this is the RM login that we're using. Okay, so there are admin logins and RM logins. You can have any number of RM logins, and RM logins are those logins which are actually dealing with the client transactions and client money, risk profiling reports, etc., etc. So as an RM, you created the clients, and now you are going to CAS upload. You are requested to input the PAN number before uploading the CAS because this is a necessary requirement. Okay, so let's say that I'm just inputting a dummy PAN number for the time being. Save the PAN, and after that you're actually getting the instructions in terms of how to upload the CAS and what are the things that you need to be careful about before uploading the CAS. So mind you, here we are actually looking at the transaction CAS, not the summary CAS. Okay, choose a statement type as detail. So if you click here, it will be taking you to the CAMS CAS, and then come to the detail CAS over here, and then all the instructions are given here. Select the zero balance, without zero balance folios, and so on and so forth. Input the password. All of that instructions are given here. And all you need to be doing is once you get the CAS file in the client's email, ask them to forward it to you, and you can actually just upload the CAS file from this login. Input the password that you have keyed in here. Okay, so it is going to be showing you at that point in time a processing of this thing, and then it will also be showing you that what is the time that is going to be taking. All of that will actually be shown. So but I'm not getting into that particular process because it takes some time for the processing of the CAS. Okay, So now I'm going to be moving into an existing client who has already uploaded the cash and whose portfolio is now available for a review. So I'm going back to my dashboard and I'm searching another client here, demo, and I'm clicking on access. Okay. I'm coming to holding, which is on the left hand side. After the access, come to mutual funds, and the moment the cash is uploaded and the processing is completed, it will actually show the investment value, the current value, and the portfolio XIRR that it is generated. So this is the total summary of the investments. What is the total investment value? This is the net investment value, obviously, and what is the current value as on yesterday. And after this, it is going to be getting updated on a daily basis. Provided there are no transactions, then of course you will actually be seeing the latest updated value all the time. And this is the portfolio XIRR, which is 16.71 percentage. And you will also be able to see all the funds being listed in the cash. And the good part over here is that again it is running on the basis of transactions, so you will be able to see the XIRR, the scheme returns. As you can see that this is the XIRR, and we are also taking the benchmark returns as well. So for every scheme there is a benchmark. We do have the data for that. So what would have been the returns if you had invested in the benchmark at a scheme level is also being shown here. Okay, so this is the net investment value, the current value, whatever withdrawals that they've made, the profit loss, which is the current one, the unit balance, and the NAV, the scheme returns, and you will also be able to see the transactions which has happened in this particular fund, starting from 2021 going all the way to July 2024. Okay, so think of it like this. Not only are you just getting the summary, which is the most important part here, because a lot of platforms are just processing the summary file and they will show you the current value, but not giving the entire context in terms of transactions and especially the XARR and things like that. Okay, so we cover that, which is why we insist on processing the detailed statement and not the summary statement. Okay. Now I'm jumping into the optimization part, which is the uh, tutorial that is intended for today. Okay, so the first part is you can actually see an overview. Okay, an overview is nothing but the total macro analysis, sorry, the total investment that they've made here, which is something that they've seen in the previous tab as well. 4 crore 12 lakhs is the investment value, and it is worth 6.5 CR as of yesterday. Okay. Now this is the 16.71% is the XIRR, the time weighted returns that is generated on the portfolio is 16.71%. Okay. Now this is the most important part. So we are actually giving you a bigger picture via the overview. And this figure is if you had invested the same amount of money into the scheme benchmarks, then this would have been your portfolio XARR, which is 13.13 percentage. Okay, now this is something, according to my best understanding, is not being given by most of the fintechs. Okay, they're all giving the scheme benchmarks, but not actually the portfolio benchmark. But this is going to be giving you the portfolio benchmark, and why is it important? Because this is the bigger picture. At the first glance itself, whether your portfolio is outperforming the benchmark at a higher level is something that is going to be known to you, and everything else is like secondary. So in this case, there is a clear alpha of close to 3 percentage, which the client is enjoying, which means that the client has actually made better investments at a scheme level and a asset class level, and so on and so forth. Okay. Now your asset allocation is towards a conservative model, which is probably he would have had less of equity, or maybe other asset classes would have been higher, like hybrid, etc., etc. And so, therefore, we are actually saying that the expected returns will be lesser going forward, and hence it is good to check if it's enough to meet your goals. And that is something that we are just giving as a caution to the users, saying that your model is conservative, so probably the expected returns going forward is going to be lesser, and therefore just check whether it is enough. Okay. And the total number of schemes that they've invested, how many have outperformed, how many have underperformed, is a very basic information again that is being given in the overview. Okay. Now if I go to macro analysis, here I can see that the total asset allocations over here. So It's just about 45.6% is into equity, fixed income is 18.3, global is 14.5, commodities 13, hybrid is 8.6. So you're being shown the entire asset allocation in the first place, and you're also being shown the kind of fund categories that they've invested into. Large and mid cap occupying the largest place with 16.2, thematic, floater fund, etc., etc. All of that particular thing is being displayed over here. Now, this is extremely important, which is the split of the portfolio based on the AMFI riskometer. So, how much of that is into aggressive, how much of that is into moderately aggressive, conservative, all of that particular thing has been shown here. And this is the AMC breakup, which is very, very simple. And here comes a market cap breakup. The large cap, the mid cap, others is probably the global funds that we've actually captured here. Okay. Now, this is another one, which is the duration, is a very, very important aspect. Now, this is not the real, sorry, the typical fixed income duration. This is, we've actually split the funds based on the ideal duration or ideal holding period. So, suppose if you are holding a liquid fund, it is meant to be ideally held for a period of 3 to 6 months. If you're holding a large cap fund, it is meant to be held for a period of about 5 to 7 years. If you're holding, let's say, a credit risk fund, it is supposed to be held for 3 to 5 years. So accordingly, we are splitting the entire portfolio. So here is where it get very interesting. The client's portfolio, 37.5% of the portfolio time horizon. Okay. And 5 to 7 is 25%, 3 to 5 is 25%, etc. etc. Now, why is it important? So think of it like this. From a big picture point of view, your let's assume that for simplicity's sake, 100 rupees a portfolio value. 37.5 is the rupee value, which is there for less than 1 year. Okay. And you have a goal which is coming up for 1 year, and the value of the goal is, let's say, 60. Okay. And rest all, after 37.5, rest everything is into 3 to 5 years and 5 to 7 years and so on and so forth. So what does it say that you have, and assuming that this is the only money that you have. Okay. So what is going to happen from an advice point of view that you should ideally be giving to your client is, from that 62.5, which is 1 minus 37.5 percentage, a portion of that should be allocated further to less than 1 year, because you need to meet that particular goal which is coming up in the next 1 year. Okay. So this is that process of ensuring that the portfolio duration is matched or aligned with the goal duration. Okay. It's a very, very important factor. So this is something which is going to be helping you in terms of doing that particular thing, because again, according to my best understanding, nobody is really actually doing this duration thing currently, as far as the portfolio analysis is concerned. So I'm moving into another tabs, which is the risk analysis. Now, this is again extremely important, both from a functional perspective analysis as well as from a compliance point of view. Okay, so we are plotting these risk ratios. So we capture about 11 risk ratios here, starting with maximum drawdown, upside, downside, etc., etc. And what we're also doing is, you can see that there are two colors that we've denoted here. One is green, another one is red. Okay, what it essentially means in a very simple manner, think of it like this: anything which is green is actually good, and anything which is red is not that good. It essentially, the way that we've derived is, we've taken a benchmark rates for everything. So, for example, putting it very simply, let's say standard deviation, the 1 year standard deviation is 16.45. Okay. So we would have a default value for standard deviation, which typically ranges at about 13 percentage for a portfolio like this. But this portfolio standard deviation is above that acceptable range of 13, which is why we have marked this in red. So which means that the 1 year standard deviation for this portfolio is above or beyond the acceptable range. Whereas when it comes to 3 years, it is lesser. It is within the acceptable range, and which is why it is denoted in green. So whenever you're constructing a portfolio or whenever you're reviewing a portfolio, you need to be making sure that the portfolio that you recommend, especially, should be ideally be having more number of greens and red. Simple. Okay. Now, this is another thing which is extremely important. This is the portfolio risk profile. Okay, and this is plugged into the high risk model at this point in time, starting with a high risk band, and This is the personal risk profile, the risk questionnaire that the client has filled, and he falls into the moderate risk category. So there is a huge mismatch between the portfolio risk profile and the personal risk profile over here, which invites for the compliance issues as per the SEBI circular for this thing. And we built a complete end-to-end solution and system for the risk profiling as well. So that is something which we have sort of going to be. We've already covered a tutorial on that, but again in the portfolio analysis, we are sort of putting it across as under the risk analysis thing. So holding analysis, another one. I'm not really going to spend too much of time here. Basically, it talks about top 10 stocks, top 5 sectors, and credit breakup, etc., etc. Now, this is very important, which is the correlation and overlap. It basically gives you the scheme correlation because the client is holding many number of schemes. The graph is getting a little messy, but all you have to be doing is ensuring that from an ideal portfolio mix point of view, there has to be more number of greens over here because this is like on a scheme to scheme level, the correlation values are less than 0.25. So first of all, the correlation is being matched in a band of 0 to 1. The closer it is to 0, nothing like it. And of course, there can be negative correlation as well. And the more closer to 1 it is bad because it is highly positively correlated. So the bands that we've given here is anything which comes in the red, which comes in low diversification, falls between 0.75 and 1, which means that the two funds doesn't have too much of diversification, and between zero point 0.5 and 0.75 falls under moderate, 0.25 and 5 falls under good, and anything which is less than 0.25 falls under the excellent diversification part, and the total portfolio overlap is 4.95 percentage. Okay, so this is another important thing that you need to be, especially when you're constructing a new portfolio or when you're doing a portfolio overlap. Sorry, when you're doing a portfolio review, overlap is one thing that you need to be careful about. Okay, so far we were just providing you the data of the portfolio. At the last two buttons, we are going to be providing you the analysis or the recommended actions. Okay, so let's go to impact analysis. Sorry. Impact analysis essentially talks about how, at asset class level, risk profile level, and fund category level, has your portfolio impacted and what has been the returns that it has generated, on what is the contribution or impact that it has made towards the portfolio level. Okay, so let's look at this. So this client has got 45.55 percentage. This is the returns that equity as an asset class has generated in the portfolio, 17.86 percentage. And mind you, again, this is XIRR. Okay, 17.86 percentage is the XIRR that it has been generated, and benchmark return is 17.09 percentage, which means that the equity as an asset class has outperformed the benchmark, and therefore there is a positive impact on the portfolio. Okay, now the next one you can see is it has minimal impact. So let's take a look at why is that it is termed as minimal impact. Two things. One is that the benchmark is lesser than the actual asset class return, which in this case is hybrid. So it is actually underperformed, but at the same time the allocation of hybrid to this portfolio is not that great. It is just about 8.6 percentage or less than 10 percentage, and therefore the impact is lesser. Okay, so this is the impact analysis. So think of it like this again. At a big picture level point of view, you will actually be able to know that which asset class has contributed more to the portfolio and which asset classes are not, assuming that it is a diversified portfolio. Similarly, we show it, split it on the basis of risk profile by fund category. Now, fund category is very, very interesting. I'm just probably spending a minute or less than that here. Let's say large and mid cap, the portfolio allocation is 16.16 percentage. The return is 19 percentage, and the benchmark return is 16.45 percentage. Okay, so this is again a very positive impact. Floater fund is positive impact, large cap is slightly positive impact, and so on and so forth. So this is going to be giving you that big picture perspective, in terms of which asset class which fund category and which risk profile has actually contributed positively and negatively to the portfolio uh, performance. Now comes the last button, the recommended action, which is the final recommendation that you all have been waiting for. Now, what this particular analysis does is at a security level or at a scheme level, it is actually going to be showing you different kind of recommendations: cautious hold, confident hold, buy, and exit. Okay, so let me just show you the first thing, which is buy. Okay, so this is a fund in the client's portfolio, HDFC Large and Mid Cap, and the client, this fund has got an exposure of 7.38 percentage in the portfolio, and this has generated a return of 18.19, whereas the benchmark has generated 16.13. Okay, so very clearly the fund has outperformed the benchmark, and the benchmark in this case is Nifty Large Cap Mid Cap 250 Index. Also, there is a fund ranking process that we do, which is pretty much covered in the research and advisory operating system. So fund ranking is not just on the basis of returns, it covers about 21 parameters, which includes risk parameters, which include fund manager, AUM, AMC credentials, and so on and so forth. So based on that particular ranking process, it is ranked number 1 out of 28. And every quarter we update the ranking. So based on the latest quarter, which is 30th of June 2026, this is 1 out of 28. Okay, so this in both the parameters, both in terms of the scheme versus benchmark and also in the ranking, this fund has actually scored very well, and therefore it is a buy. Okay, now we'll come to an exit mode. Okay, let's take Miri Asset Large Cap Fund. This fund has underperformed the benchmark. It is 12.61 versus 13.69. Similarly, also in the ranking phenomena, it is 13 out of 31, which means it is not in the first quartile. Okay, so if it has to come into the into the buy parameter, it has to outperform the benchmark, and it also has to be coming in the first quartile. It need not be the first best fund. It has to be coming in the first quartile. Then we keep it as buy. But in both the cases, if it is failing, then we keep it as exit. Okay. Similarly, for hold also, if one of the parameter is scoring, whether it is a scheme versus benchmark or whether in the form of ranking, it is scoring well, then we keep it as hold, because we are not going to be giving an exit recommendation just like that. We are very careful about giving that exit recommendation. Now, the good part is you will actually be able to change in case if you feel that okay, this is probably not completed so much of time and therefore you need to be giving, or if you're for whatever reason you're bullish on a particular fund, if there is an exit recommendation that has come, you can move that to none, or you can move that to confident hold or or buy, or sorry, cautious hold, or anything for that matter. Okay, so this process is the portfolio review where you're getting the complete picture after uploading the cash. Now the good part is you will also be able to generate a report. You can also select which are the information that you will actually be requiring, and if you generate the report, your logo will be here, not the FNAB logo. Your logo is going to be here. And then whatever that I've shown you in that UI with respect to the the macro analysis, risk analysis, all of that is actually being printed here, and you can download this into the PDF. Okay, so this is just one step or one part of the total portfolio optimization process, because what you've done is portfolio review. And then obviously when you're going to be giving these kind of recommendations to the client in terms of exit and buy and hold, etc., etc., the natural question which is going to be coming from the client is okay, what next? Right? What is to be done for the you tell me. Now that is where we are going to the next step in terms of optimize your portfolio. Okay, so under the optimizer portfolio, you have something called as a scheme rebalance and a portfolio rebalance. I'm going to be covering the scheme rebalance here because that's a little more simple and straightforward. And this is exactly what all the D2C fintechs are doing at the moment. So what it does here is any scheme in your review which has come as exit, okay, that you see here, you have an option to replace that scheme, which is called as a scheme rebalance. So, for example, Miri Asset Large Cap, I click on this plus button, and I come to fund category and I say that equity, let's say large cap, and I choose, let's say DSP large cap, I add it here. Okay, very simple. And then you have an Aditya Birla dividend yield fund, and let's say that I'm choosing equity again. I'm choosing a focus fund, and I'll choose Aditya Birla focus fund just for the purpose of demo. So you have two other funds, DSP India Tiger, and you also have an option to sort of choose it from your favorite funds. Whatever that you've already bookmarked, you can see it over here. So it becomes very easy for you. So you can just click on Nippon India Large Cap, which is one of your recommended funds. And finally, Aditya Birla PSU Equity Fund, which you can also search it by this. And let's say you do it with Axis Cap. So the good part is you have multiple areas of doing it. You can either bookmark, fetch it from your bookmark funds, your favorite funds, or you can search any scheme, or you can do a navigation in terms of the asset class and fund category and pick up the fund from there. Now, when you are clicking on submit, what you're seeing is actually a comparison between a new portfolio and the current portfolio, which again, in my best understanding, nobody's doing this. Especially in the B2C space, nobody's really doing a comparison between an existing portfolio and the new portfolios. All of that particular thing can actually be seen here. I'm not really repeating that entire thing, but take a look at this. It is going to be showing you the transaction action. What is a Mirae Asset Large Cap, which is an exit, which is what sell, and there is no short-term capital gains here, and which is a new scheme. Similarly, Aditya Birla dividend field switch, there is no STCG. Transactions have also been, the tax components have also been generated. We are not capturing the exit load factor at this point in time, which we soon will be. Now the good part is you generate a report, and the very final one will actually be coming with the transaction summary, and you can just click on share report here, and it will be shared with the client, and it will now be sitting in the client login. So as we've always been saying, the beauty part of using FinApp is that you have execution or transaction integrated with research. So from the client login, with a single click execution, whatever be the sell and the switch orders which are supposed to be performed will actually be performed from the client login. The client can review the same report and then click on optimize, and it will actually be sent to BSC for the order execution. And if it is a switch order, it's all the more easy. If it is a sell order, it's going to be taking a couple of days for that funds to come in, and then you can reallocate that to the new funds that are recommended. So it's an extremely powerful end-to-end one module which is taking care of review, optimization, along with transaction. So I'm stopping it here. It's been a fairly long video. Anything that you would want to sort of clarify on the portfolio review optimization, as always, please reach out to us on email or on WhatsApp, or on phone as well. We're always happy to sort of take your practice to the next level. And this is one module which I strongly insist and urge all of you to sort of take a look, because this particular feature has been fairly exploited by the B2C fintechs such as Deserve, Power Up Money, Novelty Well. I'm just taking about three names now, but a lot are coming in. We are also working with a lot of fintechs for powering up their APIs and stuff like that. So we know for the fact that a lot of them are coming up. So please do not lose out your existing clients. Upload your RTA files, give them a review much before than what Deserve reaches out to them, and also use it for a client acquisition purpose. Create a client as I've just shown you, upload the cash, present this beautiful report in a span about 5 to 7 minutes, increase your brand equity by using the portfolio optimization. Thank you so much for watching.